Patrick, hope you and your team don't mind us lifting your list for our RBI. I read the note in prepping for this interview, and I thought, yeah, this would be a good RBI because we're all kind of looking for opportunities. You guys aren't saying these are going to surge, correct? You just think they're going to benefit more than weaker dollar names.
Correct. Yeah. I think the question is why do we think the dollar is going up? And there's really three reasons here. There's higher interest rate policy here in the U.S., faster growth within the U.S., and then a little bit of a flight to quality. Those three items are continuing to drive the dollar strength. And what we have done for investors is put together a list of companies that are most sensitive to the rising dollar to allow them to take advantage of this dollar strength.
Yeah, and do you guys expect this to last? I mean, I remember God, I'm old enough to remember when the euro and the U.S. dollar hit parity 20 years ago. It was like free money going to Europe. That didn't last very long. Is strong dollar here to stay?
I think if you look at those three reasons, the flight to safety, I think, can be unwound should we begin to see some of the zero COVID policies maybe dissipate or the war in Ukraine begin to dissipate. I do think, though, that the interest rate policy differentials in the U.S. and the fact that we are seeing faster growth, GDP this year on a nominal basis is expected to be around 9%, those two are probably going to continue to support a stronger dollar. Now, the dollar's already moved a significant amount, so we don't think that we're going to see the same level of appreciation, but we do expect the dollar to continue to drift higher through year end at least.
Now, you guys recently lowered your S&P 500 target from 5,200 to 4,900. By the way, Patrick, I think you and everybody else are going to have to do this, but you're still seeing about 14% upside for the equity markets this year. So the biggest rallies we've had on a percentage basis have come actually in bear markets. Do you think we are in a bear market, whether we're down 19 or 20%, right? Who cares, effectively, Patrick? And what is behind still some obvious optimism for the second half of the year?
Well, I think to your point, I mean, splitting a hair of a percentage point doesn't really make that big of a difference. There's a lot of pain for investors, particularly when you look across technology shares and, for example, like the Russell 1000 Growth Index. So I think a lot of people are feeling a bear market, even if we're not exactly technically in that bear market. I think really much of the sell-off has been driven by really elevated valuations that started at the beginning of the year. We started at 21.5. Multiple, we're down to a 16.5. So that's a significant derating. And during this period, the fundamentals remain intact. In fact, we've seen EPS estimates continue to drift higher for 2022. So I think investors are concerned about the deceleration in economic activity. And look, let's be clear, the economy is decelerating. The question is, are we going to be recessionary if we continue to slide? We don't think that's the case. I think most investors are prepping really for that recession scenario. As I mentioned earlier, GDP this year on a real basis, 3%, on a nominal basis, 9%. It is slowing, but that is far from recessionary. And that's what investors are really positioning their portfolios for. And we think it's really overdone.